Hi, everybody. We're letting everybody in now. We got a few people dropping in. We'll give it a minute or so. We'll do some housekeeping as everybody comes in. You'll see at the bottom we have a Q&A and a chat. If you have a question, make sure you type it in there. If you'd like, you can shoot an email out to invite somebody to this, and we'll get started here in a minute or so once everybody drops into the call. But welcome to our mid-year quarterly economic update for Stein Wealth Advisors, everybody. So,
hi, everybody. Hope everyone's doing well. Enjoying the nice weather. Well, at least it's not raining.
That's right.
It's been raining a lot lately.
A little bit, yeah, here at least. So.
Yeah.
Well, cool. Well, I tell you what, I think everybody that we knew were dropping in has dropped in. Anybody that comes in later, they could get going. But we were trying to keep these under 15 minutes. I know the three of us love to talk, so we'll get that going and we'll wrap it a little bit quicker than we did before. But we have a couple very important things we want to cover. This quarterly or mid-year economic update, we wanted to cover treasury yields versus the equity market. We wanted to talk about inflation a little bit. We wanted to talk about the volatility in the U.S. market, economic expansion, and some opportunities that we all want to keep an eye on. But kicking us off, Josh, you wanted to tell us a little, you were looking at the U.S. treasury yield market versus the U.S. equity market, which most people don't think yields when they think U.S. equities, but like, there's some correlating factors there that were interesting to you. So tell us what you were finding out.
Sure. Hi, everybody. So I think we've started to see a little bit of some redundancy in the last couple months with like what the news is talking about, what the stock markets are reacting to. We're starting to see kind of a trend with what people are focusing on and following. And so I thought I'd talk just a little bit about what some of our assumptions are and what's right, what's maybe not so accurate in how the media talks about things. But we obviously hear the word inflation a lot right now. I mean, that's all over the news. If you flip on anything stock market related, they're talking about inflation. You hear the Fed talking about things all the time. Obviously, it's important. We hear treasury yields a lot, right? I mean, that's something that I don't think as many people understand as much and how they influence the stock market, but we're hearing treasury yields a lot. What else do we hear? Obviously, stock market volatility, right?
And that started, I think, over the last week or so, people are starting to perk up again.
Yeah.
I mean, their ears are starting to perk up because they're seeing that.
And on the flip side of that, we hear all-time highs, right?
Right.
So, one day we're hearing stock market volatility, the next day we're hearing all-time highs. So I thought I would just throw a little bit of perspective into some of these things.
Cool.
First, inflation is obviously very important. And Joe and I had a whole webinar a couple weeks ago about inflation and our thoughts on that. But I do want to reiterate the fact that inflation is not an easy concept to really understand with regards to how it relates to the stock market. And I won't get into necessarily the impacts of inflation in other areas, but I will go as far as to say is we can't make a direct correlation between rising inflation and negative stock market returns. Not to say that can't happen, it certainly can, but they're not that closely correlated where you can make that determination. There's too many other economic factors that come into play, and in which case many of them are actually positive stock market returns, which we may see. We may not, but I'd just like to throw that out there because I think people get a lot of anxiety about hearing about inflation and thinking, oh my gosh, does that mean we're going to be in a recession or see a stock market crash? And that's not necessarily correlated.
No, and on that note, I mean, even though the media just recently started, I think over the last probably 6 weeks talking about inflation, we as a group have been talking about inflation since last fall because, we could kind of see that the recipe for that, a rising inflation environment coming for a while. So we've been making adjustments to the portfolios sort of in anticipation of that. But I would say historically, periods of higher inflation can often be positive, related to positive stock market environments because, the assumption is that as inflation's rising, interest rates are rising, which means, the Fed's having to cool down an economy that's, maybe growing a little bit too fast. So, I mean, but that, like Josh said, there isn't a direct correlation between positive or negative stock market and inflation. It's a little bit more complicated than that.
I think the big thing for everybody to understand is we are understanding that this inflation is real. It may be here to stay, and we are taking those proper precautions with the financial planning side of it. But as far as how that affects the overall economy, we're taking that into consideration. It may be a different effect than you think as far as inflation goes. But
Well,
those are
in,
good
in
points.
this situation that we're in currently, when we, as a side note, in our last webinar, Joe and I talked specifically about a lot of the reasons why we see inflation, like what brings inflation on. And I won't go back into all of those, but the big one we have now, and it's the pretty obvious one, it's also the elephant in the room, is just all the money that's been printed. And that's really what's driving inflation now, which is different than in other economic periods where inflation has rapidly increased for other reasons. But I mean, it's pretty simple. We kind of know why it's happening right now. It's just there's so much more money in the M2 money supply than there ever has been, and the velocity of how much money was entered into the money supply in the last year was faster than
it's a 30% increase year over year between last year at this time and now. The M2 money supplies increased by 30%,
which was no surprise. I mean, we knew that. We knew this as soon as the Congress started passing these massive stimulus bills. I don't think.
Well, and the Fed has been,
yeah,
the Fed's been buying bonds and putting money in the system, low interest rate, easy money environment. I mean, that's why we knew inflation was going to increase. It's also why we know, and one of our favorite economists uses the word transitory, because the Fed's saying a lot that, oh, well, this inflation isn't going to be, it's not permanent. It's just happening because these disruptions in the supply chain, blah, 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 all this other stuff. But really, the only real reason it's increasing is because of the increase in the money supply. And it likely is, some pieces of it are permanent. Maybe some of it aren't, but certainly we're expecting higher prices in the next, in the near future.
Yeah.
Yeah, the Fed's definitely gambling on this transitory word, and I think everybody is taking that with a grain of salt, and how much of it will or won't be transitory is the big question, and that's certainly a concern. I mean, there's no question about that. If we don't see a cool down in inflation, what was it? The last reports were over 5%, which was way hotter than I think the Fed wants it to run at. But how much of that is long term? The Fed's saying it's not. We certainly need to watch that. And there's a lot of other things we need to watch, but let's take a look at some current economic data that's come out recently. We're expecting Q2 GDP growth to be over 8%. Historically, that's actually extremely good. The quarter before that, it was 6.4%. So it's trending up.
But that was to be expected because we're looking at, year over year from last year, when clearly there was a huge dip in GDP growth. So
yeah, and the question is, how much of that is the sugar high of all the free money that everybody has? Money's cheap right now. Money is flush with all of the stimulus and extra money that people have received. So 8.3%.
Right, we're coming off lows.
Yeah,
right? So
it's GDP growth is phenomenal. If you just saw that on paper, you'd think we're in a wonderful economic environment, and maybe we are, but it does need to be taken, I think, certainly with a grain of salt, in the fact that a lot of that is probably propped up, and how much of that can continue in the future. I don't think we're going to run at an 8% or 6% clip quarter over quarter through the end of this year or in 2022.
No, that's going to start cooling down in the later half of this year, and the next year sort of equalizing.
And the other thing I like to point out is, if we're at an 8.3% GDP growth and 6.4% before that year or the quarter before, post-COVID, even with all the stimulus, what would it have been if we didn't have COVID? Probably even better. So there's an opportunity cost involved there with it, which is, even though that number is great, it should have been better. And that goes to lost jobs, businesses that have gone out of business that haven't come back. We talked about on the last call it, we talk about flipping on the economy like it's a light switch, but it doesn't work that way. When you flip it on, there's still people who never got their jobs back. There's still businesses who have gone under. There's still infrastructure that hasn't come back. And that, what does that mean for the long term? We don't
really know yet.
So I wanted to touch on that, and I think that's a good segue there. So some people were saying, okay, so you increase M2 supply by 30%. Everybody's back relatively to work, and all these businesses are hopefully reopening. What is slowing the U.S. economy down? Why isn't it expanding faster? And I found some interesting research on that, where we were talking, some of our economists were saying, what sectors are going to lead the U.S. economy back out of this? And it was manufacturing, housing, and consumer spending were two of the more likely ones to lead us out of that. But let's look at those sectors, right? Although they've all expanded and we've seen good economic expansion in a lot of these sectors, what's backing up some of these key ones. Manufacturing. You spoke to any manufacturing clients recently? It's hard to get inventory or stuff or the stuff they need. Same thing with the housing sector, right? We see a very interesting housing sector where low inventory, difficult to
Not
get
building enough
materials.
houses.
We have trouble with our supply chains of timber and other materials out of Mexico and some of the foreign places. And lastly, consumer spending. We had the entire economy was shut down essentially last year. People had pent up spending and they were able to spend it on goods, but not necessarily services. So you have this gap in spending on services that, I mean, if you tried to get a contractor hired lately, it's very difficult because everybody's booked out. So there are some existential factors with flipping that switch back on that are kind of slowing the reopening as well. So we're muddling
Plus,
through
we're
this
starting to
whole-
hear about the Delta variant, and
Excellent.
and that's part of what drove, I think, some of the volatility
Yes,
earlier
ma'am.
this week is the fact that they're saying, there could be shutdowns again. There's always the chance that if we need to do that, then it's going to slow that growth even more. So those are some of, like, I think those are all some of the, like, the
Very good.
negatives, some of the headwinds to the economy growing, and also like potentially the stock market growth. But there's actually some good stuff going on too.
Absolutely.
And so,
Yeah, I mean,
think we should talk a
the
little bit
Delta
about that as
variant
well.
is obviously a concern.
Maybe a little.
I think we're all like
reaction
just
on
so
Monday.
tired of hearing about COVID that we're almost like immune to it at this point.
Good pun in there somewhere, Josh.
Yeah, and the Delta variant is certainly that's like the last thing any of us want to deal with right now.
No, but it's a real risk for,
It's a risk.
for places that aren't have
Right.
lower vaccination rates.
At the same time, I can't foresee a situation, even with the Delta variant being even more, maybe even more severe than we're predicting, that we were going to be in like a March 2020 scenario. I mean, it's just a different ballgame.
No, I don't think that's the risk either. I don't see that as being the risk
No.
either. The risk is that it could just continue to slow down the recovery.
Yeah, I mean,
In some of these industries, I think particularly that have been impacted, like retailers, tourism, restaurants. I mean, those industries are still suffering.
Travel con-
Now they're suffering from lack of workers too.
I think it's gonna
they
be-
can't get people to come back to work.
Right.
So
I think it's going to be a volatility driver, maybe more so
Yes.
than it's going to be a
that's
disruptor
a
of the
really good.
economy.
That's a really good way
Very
to say it.
good.
And volatility is something that isn't necessarily bad, right? If you're sticking to a strategy and you have a game plan and you're managing your volatility.
Well,
which
and sometimes
obviously
it creates dislocations and opportunities
Yeah.
in buying and selling, and rebalancing and doing some of the things that we do for our clients. So we don't necessarily think it's bad, but I think most of our clients, when they start to hear volatility is picking up, that's when their ears perk up. They're like, oh, wait a minute, what's going on? And they see that as a bad thing, but it isn't always.
Well, ironically, if you just look on paper, data that's here right now, and obviously it takes more analysis as to like what's real and what's not. But if you just look at the data with an 8% GDP growth rate that we currently are experiencing, and a decline in the treasury yield that we've seen, way off its highs. The last week it closed at 1.36%. The reason I won't go into too much about what the importance of the treasury yield is. We had a whole talk about this, Joe and I.
Yeah, just talk
discussed.
a little bit about it because I think it's helpful.
Well, there's a correlation between inflation and treasury yields, essentially, as inflation increases. If we see a runaway rapid inflation increase, we're gonna see less demand for bonds, long-term bonds like the treasury yield, because people don't want them. Because as inflation goes up, their interest rates will increase, and if interest rates go up, then bond prices go down. So people don't want to be kept with holding longer-term bonds. So if nobody wants them, they have to pay people more to take them. And that's why you see the treasury yields increase. Just purely speculation that inflation will go higher, which means the Fed will raise interest rates, which means treasury yields have to go up to make them appealing for investors to buy. We saw treasury yields approaching 2% over the last several months, coming off of COVID lows of well under 1%. So, I mean, just a staggering increase in that treasury yield, which was indicative of speculation of higher inflation. That being said, economists use treasury rates to discount stock markets or economies to determine fair value of, like, what should the stock market be worth? What should the S&P 500
Is it over or undervalued?
It's over or undervalued. There's a use of that treasury number for just a couple easy reasons. A, if you can make a lot of money in a treasury bond, then you have less reason to buy into the stock markets. B, if treasury rates are up, it means interest rates are up, which means it's more expensive to borrow money. So corporations are paying more in interest. So there's just a use to use that rate. At current treasury rates and current GDP rates, many economists are valuing the stock market at 45% undervalued. Now, when I look at that, I say, okay, is it really 45% undervalued on paper? Yes, but we need to probably take into consideration the sugar high of the GDP rates.
Well,
and
potentially the distortion of the treasury rates because of everything that's happened.
And the distortion of the treasury rates because the Fed is intentionally and almost manipulating rates to stay low. And how long can they do that for? That's a question. So certainly, like, we have to take that with a grain of salt. But in order to even reach fair value in the stock market, the treasury would have to go up to 2.4%. Even at 2%, the stock market at the S&P is still well in the black in terms of its valuation. And what I guess my takeaway from this is we have a lot of wiggle room. And despite the volatility, unless we see massive decrease in GDP, like the sugar high just wears off and all of a sudden everything stops, or close. And then we see runaway inflation with the Fed having to take precautionary measures and drastically raise interest rates quickly. Unless that happens, we actually feel really good about equities. It doesn't mean we won't see volatility. We're going to see volatility, but we're okay with that because we're always planning for volatility. But we actually still feel like there's opportunity on the equity side. Yeah. And it's nice to remind people of that because it doesn't.
When you start seeing drops like Monday and last Thursday, I mean, it does freak people out. I mean, there's, for lack of a better
our recency bias, right? We have that recency bias, right? We all have that psychological part in our head where the last thing I remember is the last thing I remember. So as we start getting into this, I think that there are a couple of tips we wanted to close with. So maybe we should be prepared for a little bit of volatility. If you
I think that's fair to say.
We wanted to know where our opportunities are. So everybody probably on this call is working with us, or they should be, and they have their financial plans laid out. So we have opportunities to take advantage of, whether it be with rebalances, conversions, et cetera, take advantage of these situations. And lastly, staying connected with us. So coming in for your annual review meetings, making sure that you're engaging with us.
Knowing we're here if you need us,
we're obviously here if you need us, but is there any other?
Well, if we're watching these things, I mean, you know, every single one of these indicators we've talked about and the data that we've discussed and what potentially could be happening in the future, we take into consideration when we have our investment committee meetings, and we do our best to kind of proactively think through what we think is more minutia, what we think is important, maybe what hasn't even been focused on, and we try to take all of that into consideration. And if things change and if indicators change, you know, we're not taking this lightly. And I would say we're cautiously optimistic though, with regards to at least closing out 2021.
Yeah, cool.
But we have to watch these things because if any one of these factors changes, then that may reevaluate that. It looks like we have a question.
Right, and there's no silver bullet to combat inflation in a portfolio because it has different impacts on equities, on bonds. But that doesn't mean we're not doing things to adjust to.
Cool.
So,
Question.
question.
Check that question.
Yeah, let's check.
So, this question.
How did you see? I didn't see that at that time. Okay, there.
All right. Is there such a thing as average inflation? Great question. And John, thanks for asking that. So, is there a thing as average inflation? I think yes.
I mean, it's been. Well, you can take it if you want. Go ahead.
It's hard to really answer that accurately. Well, yes, there is,
For the last 30 years.
but there's a reason because in modern day economics, and at least in the United States, the Federal Reserve plays such a strong role in manipulation.
And they have a target.
Yeah, and when I say manipulation, that's not necessarily a negative thing, but they're able to control inflation more so than in prior economic periods when the Fed didn't have as much control.
Because they're controlling the M2 money supply, which is really the main driver of inflation.
We've seen exceptionally low inflation over the last several decades, averaging around 1.7%, with the Fed target of about 2%. But that's not because the economy's kind of normal trajectory is 2%. That's because the Federal Reserve has manipulated bond purchasing, interest rates, all sorts of levers that they can move and pull to manage inflation. Plus, on top of that, we've seen really, really good economic growth. and we've seen strong stock market performance.
During
So
that time
the
period.
Fed hasn't had to really start to leverage slowing down the economy that could potentially cause other factors that could
Drive
make inflation run higher. So we've just seen a really healthy environment to have low
Well,
inflation.
even in 2008-9, they did the same thing with the M2 money supply, but it never got circulated. So we didn't really actually see the resulting inflation from it. Now this time it's different. It's actually been, it's in the money supply. It's being circulated. People are spending it. I mean, it's happening.
I think if you were to ask the Fed, they'd say a 2% average 20-year inflation trajectory is what they would call healthy. But that's also over a 20-year period. So that means it could run hot for several years and then run under 2 for several years, and they would say that that's
And
good.
that's actually some of the concerns by a lot of the economists now is the Fed for the first time in a long time is saying, well, we might let inflation run a little bit higher than the 2% target. And that's where this, like a lot of this discussion is coming in. So
That's great.
good question.
Yeah, good question.
Any other questions?
Let me see, I think we got it. I think we answered it.
Yeah,
So,
we did. So we have
anyway,
to close it out with the X.
So,
Yeah,
all
we
right.
have to close it out with the X, I think.
Oh.
To make it go away.
Oh, okay. Here.
All right.
Yeah,
So we
okay.
promised to keep this brief. We're already over.
We're a
We said
little bit
we'd
over,
be.
but I think we did.
But
good.
I
We're
think
under
we
a
did
half
pretty
hour.
well.
We're under a
Yeah.
half hour. I think that's good.
We're gonna do this quarterly. Any feedback, always helpful. If there's something else you want us to talk about or some other focus, but we're gonna keep this conversational and, Q&A and just try to target the main issues that we think are at hand. So we appreciate you being on the call today. Let
Yeah.
us know if there's anything else you want to hear about.
We'll have this up on the website as soon as we can.
Yep.
So
Yeah, we'll send it out
So
to
make sure you guys like, share, subscribe, sign up for our next ones. If you know anybody that would benefit from hearing some of our comments on the past quarter, please forward this along to them and share it with them. So guys, anything else to share? I think things are
No.
chugging along pretty well, and I guess we'll see you next quarter.
thanks.
So
Thanks.
thanks,
Bye,
everybody.
everybody.
Bye.